What's up, fundrise fans? Good morning. Coming at you from the parking lot of the Fresh Market. I woke up really early this morning and didn't have any coffee. Figured I'd drive over to Fresh Market, grab a fresh cup of coffee while I bought some beans, and it turns out they don't open until 8 a.m., so I had 40 minutes to kill. Decided to catch up on my email and was reading Fundrise's most recent email that I've received. I think it's the most recent update in our newsfeed in the app, and it's called Stability in Uncertain Markets. I read through it. I thought it was a good update. And the section about real estate growth, there's two projects. One's in Charleston, Hanahan, if I'm not mistaken, Charleston, South Carolina. And one is in the greater Charlotte area, Charlotte, North Carolina. Both are build-to-rent properties. One's a townhouse in Charleston community, about 200 units. The other one's in Charlotte, is build-to-rent single-family homes, if I'm not mistaken. And they are both above 90%. The one in Charleston is between 90 and 95% rented. The one in Charlotte is 100% rented. And I highly recommend reading the update. I thought I might be able to read it to you, but my camera won't let me pull up both apps. And basically what it says is that the real estate growth J-curve, right? J-curve is performing. I can't find Fundrise's words, so I have to do this from memory. What I did was I looked at my portfolio. I have about 14% of my approximately $600,000 of assets under management between my taxable account and my Roth IRA account. The Roth is only in the Fundrise Innovation Fund. I think that might only ever be in the Fundrise Innovation Fund. But the taxable account has about 14% in real estate growth because I started my Fundrise portfolio early 2022. Not a great time to be buying real estate. And so that's why you see that the smallest allocation to my portfolio was real estate growth. Well, Fundrise and Ben Miller are telling us times they are a-changing. So I am listening. I am reading. I am listening. And Ben told us 2 years ago that the right Fundrise investment, my words, not his, was private credit. And I put $373,000 into private credit, the Fundrise Opportunistic Credit Fund. And boy, was Ben right. It's performed well. I have over $90,000 of return, depending on the day that you check, because of, Service Titan's publicly traded stock price makes it more volatile, which I like. I like the juice. I like the action. Anyway, 2 years ago, the right asset allocation to invest in with Fundrise was private credit. Maybe now it's a Fundrise Innovation Fund, maybe, but Fundrise is telling us in the best way that they can, because they have to abide by a Securities and Exchange Commission rules and regulations, which I know is true, and I don't really know what that means in specific details. They're telling us real estate growth looks good. And so, because I listen to Ben and I listen to Fundrise and I read what they write, I'm paying attention. So I thought, okay, I looked at those properties that I just mentioned to you that are in the email, and I saw that they're both in the flagship fund, but they are also both in the Growth ereit 7, VII, right? Growth ereit 7. The flagship fund has $1.1 billion worth of assets, something like 75-ish assets. The Growth ereit 7 has 55 assets. 100% are build to rent real estate. Residential is the word I was looking for. While the flagship fund has other asset classes. It's got multifamily, like apartment complexes. It's got industrial, like warehouses. And I like the fact that those growth EREITs, the 7 and the East Coast EREIT, which really should be renamed to the Industrial EREIT, because of its switch to focusing less on residential on the East Coast and more towards industrial warehouses, right? I like that there is a 1% early termination fee penalty, that gets assessed when anyone sells any investment they made in less than 5 years. And that they get sold 99% of the NAV share price. And that 1% delta that gets withheld gets spread amongst everybody else, us, the investors, not Fundrise's fees. Though I have no problem with Fundrise taking more fees, just to be honest with you, as a Fundrise IPO investor. I want them to be making revenue and profit as soon as possible, but that's not my problem to solve. Anyway, I like that early termination, early withdrawal, penalty fee incentive gets distributed amongst long-term buy and hold investors like I am. My investment horizon is decades, not single-digit years. Even though I don't know how long I'm going to live, that's just my investment horizon. I'll pass this on to my heirs if so be it. So, what did I do today? I bought $595 worth of investment in the Fundrise Growth ereit 7. And I did that just because I was down about $600. And that leveled me up to an even $5,000 investment. I think I made $5,000 in the past investment in this fund. It's gone down about $600. So I put another $600 in. Checked all my bills. Well, how much can I afford to do this right now? And that's what I'm doing. That's how I think. I'm outperforming almost all of you guys over the past 2 years. So I'm sharing my thoughts and investment behaviors. And we'll see how this goes. So the first episode of the Fundrise Investors, the r/Fundrise Investors podcast was 50 minutes long. Had some what's that guy's name? Ted Kaczynski vibes to it. This one's going to be closer to 5 minutes long. We're at 6 minutes and 40 seconds. And the future podcast episodes are probably going to be closer to this. More real time. What am I doing? What am I thinking about Fundrise investments? Anyway, fans, hope y'all have a wonderful day. Hope you are listening to what Ben has to say. I hope you're reading what Fundrise is writing, and I encourage you to be more active in our Reddit Fundrise Investors community. Thanks, and have a great day, fam.